Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is George Pino. George is the CEO of Commercial Brokers International, a full-service commercial real estate firm headquartered in Los Angeles, California, with over 27 affiliate offices around the U.S. And in just a minute, we're going to speak with George about keys to getting started investing in commercial real estate in 2023. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, George Pino. Welcome to CRE PN Radio.
Thank you for having me. I'm excited to be here.
Well, I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. I've actually been in real estate for my entire career. I went right out of college. I've been lucky enough to be able to do it full-time successfully for over 30 years. And, in 2005, my business partner and I, we broke off and we opened up our own company. We've been situated in Los Angeles, in the Brentwood neighborhood of Los Angeles since then. So we're 18 years running. A few years ago, we created an affiliate network for our offices. Now we have 27 affiliates around the country and a couple others also internationally through France, London, South Africa, Bangladesh, Canada. So we were really, when we designed the company, we wanted to be a company that addressed the concerns that we saw with investors, with our clients, that a lot of commercial real estate companies didn't do. A lot of commercial companies back in the day, they would just try and look after transactions. We're more of a relationship based, and as well as myself. So for us, it's really about what's best for the client.
Awesome. Well, I appreciate you sharing that. And why don't we jump in here real quick? So we are recording this in July of 2023. The current state of the market is, how would you describe the current state of the commercial real estate market?
Frothy. I think that, and the reason why I chose the word frothy is, I grew up around oceans. So, when you see the turbulence in the ocean, the right by the beach, it's kind of frothy. But if you go out a little bit, it can be clear if you start delving in and going under the water. So I think a lot of people are seeing the froth and not really looking underneath and what's happening. So, there's a lot of changes going on, a lot of things, a lot of people are talking about adaptive reuse. Of course, the office market is pretty soft. Numbers just came out a couple of weeks ago that they're about 60% of occupancy based upon pre-COVID levels. And it's stabilized for the first time at 60% for the last 2 quarters. It hasn't really gone up, hasn't really gone down any incredible amounts. So a lot of concern on that. So a lot of talk has been about adaptive reuse on those office buildings. And from there, though, we're seeing other markets, though, that are just on fire. I do a lot of investment properties with single tenant net lease. I'm still pretty active in it. We've seen a drop down probably about 30% of transactional volume over year. And last year was really good. But that is also starting to pick back up. I think there's a lot of concerns with interest rates, what was happening. And right now, we are probably looking at, my guesstimate is that we are going to have at least one more increase. Luckily for commercial real estate, it doesn't necessarily, we're using the loans use different metrics to for their interest rates. So it doesn't affect us as quickly as it does on the residential side. So, but I am seeing that, and I think that we're looking at probably one more increase than the next, but we're seeing a lot of people hold back. And then when you look at certain submarkets, we're also seeing a lot of issues where because of new laws going into place, people are pulling back. For instance, there's what was called in Los Angeles the mansion tax. And this was supposed to raise $600 to $1 billion in additional tax it was a very high tax rate that was put on for properties that were $5 million or more. The interesting part is, since its implementation over 2 months, it's only raised about 15.5 million. So a lot less than they anticipated because a lot of the owners have actually pulled back. So we're seeing a lot of properties off market or not as much on market. So there's less supply, which, if the laws of economics apply eventually, less supply, demand still stays the same, pricing should go up, or in a declining market, at least stay stable.
Yeah. Now it's interesting how the public policy seems to be almost blind to the effect of the policy on the market. The assumption is that everything will continue as is, and not recognizing when you create pain, the natural reaction is to avoid the pain. And I do believe, like, the tax code, often the tax code is introduced in a way to create wanted behavior. If you give a tax credit, you're hoping to stimulate investment, kind of thing. But it is interesting. I find that a lot of times at the state level, the kind of the blind, not understanding what they're gonna, the yang of the yin, or whatever you want to say, kind of thing. But
yeah. Absolutely. I mean, it ultimately will get passed through to the tenants, and who then will ultimately pass through to, to their clients. So, it's really not, as they positioned it, we're only going after the money of the rich people.
Right. Yeah. Whoops, I missed. So historically, there've always been benefits recognized for investing in real estate. Cash flow, depreciation, equity build, and more recently, I think, kind of like a hedge against inflation. People recognize being invested in a hard asset as opposed to holding cash. What in today, with, just like you described, the market as being frothy, how do you see, or what are the, I guess, the questions, or investors questioning the benefits, given the high interest rates, and, like you said, the legal climate? As an insurance broker, I know the increasing the insurance cost, and all of that. Are you seeing, are these things affecting the investor interest? Are they the direct effects, or are they kind of a side, not necessarily a focus, but a part of the puzzle, as far as how the market's being affected?
Well, yeah, I think it really depends on who and the type of investor that we're looking at. A lot of the mom and pops, it causes them to put the brakes on. But I think astute investors, or investors who have done this for many years and understand that, the markets are cyclical, they understand then it's not so much of a pause or so, but more part of the bigger picture. How do we make it and structure the transaction so that it all fits with what the expectations are for the immediate future, the near future, and down the road for long-term, what your plan is for the disposition of the property? And that's really the puzzle piece. And a lot of people don't even look at that, as far as, they just look at today. What am I getting return wise today? But not looking at necessarily the value add opportunities that property or that type of asset may play in the future, and then also down the road 10, 15 years. A lot, especially the long-term holds. A lot of people just don't plan for that.
I'm glad you brought that up, because I think that is a fundamental distinction between say a market investor, stock market investor, as opposed to a real estate investor. At least the
Mhm.
I'd say the really significantly successful investors I know, it's something they've been doing forever and they plan to do forever. It's not like the new shiny object kind of investment, like, they heard somebody else made a bunch of money, so they went in,
Mhm.
kind of thing. And so, and you mentioned kind of the viewpoint, immediate, near, and down the road. Um, is as commercial real estate goes, is there a horizon that you typically guide your clients to, or prospective investors to look? How far in the future do you suggest they consider looking?
Well, how I work with my clients, actually, I have a kind of an intake interview, and I'm really asking them, what are their plans? What are they trying to look at? Almost getting a better financial picture of what exactly their goals are for this type of investments, whether it's asset preservation, whether it's cash flow, whether it's potential for a much larger equity build or appreciation. And then with that, we start finding the right type of properties that can then fit into that uh, time frame for their hold period. Some investors, I have quite a few investors that literally they buy it and they say, you know what, I'm just going to give it to my kids. I'm never going to sell it. And in that scenario, depending on their age, we may actually even start looking at different types of assets that may have bonus depreciation schedules, because, with the tax code, money today is worth more than money tomorrow. So if you can actually depreciate the property faster, that means that cash flow is worth more. And they don't have to worry about it if they're not going to sell it. And then when the heirs take over the property, they get a stepped up basis. So it's actually better for them to fully depreciate it. So depending on their age, it's really a factor. And the way that we look at investments is it's personal to every individual. Some are also just looking at, if they want the value add or the exit. So depending on what they're looking at, typically I look at a 5 to 7 year investment horizon for myself. That being said, I've held properties a lot longer, because it was not the right time to necessarily sell at that point, or there were no opportunities to exchange it over into something better, and it was doing very well. So it's really an analysis that's ongoing. I think that when you go into it, you should have a business plan of, here's what we're planning on doing, here's what we're looking to do. But if this doesn't happen, then we're going to go this route. And then finally, exit strategy, especially, and I get this quite a bit with our my investors on single tenant net lease is, yes, they're buying a really nice asset that's really good for one, mitigating the inflation uh, increases, because the tenant's solely responsible for the maintenance, repairs, and property tax and insurance. So it can mitigate that because you still have the increases, and you also typically have a very long-term lease, 15 to 20 years, that is typically guaranteed by either a strong franchisee or a corporate guarantee. So you have a really good revenue cash stream that's guaranteed. But the problem is, what happens when they vacate? Who are we going to re-tenant this with? And that's where we come in and start looking at, even if they're planning on holding it forever, we're still giving them an exit strategy. Like, if the tenant does not renew the lease or exercise an option, what are your plans? Here's what we're going to do. Prior to that, we're going to do this. But even before that, on the acquisition side, I'm looking at, this tenant's great, I love this tenant, but what happens if they go out of business? Who am I going to re-tenant with? Who's going to want this location? So I'm actually doing that analysis ahead of time, trying to mitigate that risk by finding out everything from traffic counts, demographic patterns, what are the growth patterns in the area, both for income and population. What are other traffic generators that are irreplaceable? Like, is there a high school immediately next door to the property and it's a fast food location? Or is there a hospital that's not going to go anywhere and you're looking at drugstores or dialysis centers? Things like that. We're looking at, well, what are traffic generators that are going to always be there? A football stadium. I saw a great property that was a Circle K with gas right next to the Atlanta Falcons football stadium. Hard to beat that location. And more than likely always have a tenant for that location. So, that's what we look for. We're always looking at not just the acquisition, but the exit. And I think all investors should be doing that, but a lot don't.
Yeah, the exit strategy. I mean, eventually, at some point you're going to exit it, whether you exit it, for the next world, or you choose to sell or whatever. But there is, I mean, to have some sort of a plan or a strategy, or like I like how you said that, plan A, B, and then or have some sort of an idea of what's going to happen, because I think
Mhm.
what we're seeing right now, and is likely going to continue to affect the market for a while, I would think, would be just how the interest rate reset, for the not the institutional lender or the investor so much as it is more, like you said, the mom and pops and smaller investors. When you're going from a rate environment of you know sub 5 to now, I don't know what a rate is right now, 7 or 6, 7 probably
Just sub
for
seven. Yeah. A
sub
sub
7.
seven right now for commercial.
Um, I know that it certainly makes a difference in your uh, your actual cash flow. And I guess it all depends on what you're coming into the property with, as far as down payment and that, and that. But speaking of that, in the asset classes that you deal in, what's the primary asset class that you mentioned, the triple net single
Single tenant
tenant?
net lease is my primary asset class. Although I still do some multifamily sales in Los Angeles for clients. And I also, for a lot of repeat clients and referrals, of course, I will handle leases as well. Generally speaking, though, 90% of my business is investment grade properties, investment sales.
Got it. Got
So,
it.
and then we have other agents, though, that I oversee, that do all aspects, from the leasing to regular sales to owner user sales, all of that.
In your activity, is it primarily sales, or are you doing a lot of leasing as well?
Sales for me.
Okay. Okay.
Company wise, it's probably about 50-50. For me, it's 95% sales.
Got it. And with that, on the sales, can you describe kind of a range, or kind of the average of what the size and type of product that you sell?
Ranges probably from, on average, 2 to 10, and then there are some investment properties or first time investors getting into it, that, because of the down payment, commercial requires a much heavier down payment than residential investments. You're looking at minimum 35% plus a debt service coverage ratio that you have to worry about. So, even though someone may have a good chunk of change, I spoke to someone earlier today, they said that they had $500,000 that they wanted to invest. And when I told them, well, maximum price is about 1.5 million that we can find. And realistically, with debt service coverage ratios and the rents and the cap rates where they are right now, probably about 1.2 million. He was shocked. He thought he could buy a $2.5 million property going out, and it's just not there at that point. So, we do have sales, though, that are, less than that. We have sales 20-30 million dollars as well for some of the larger investment stuff.
And so for like a $2 million single tenant type property, what kind of a square footage would you expect that to be?
Well, typically speaking, it's interesting in that single tenant net lease is not typically traded on square footage, but based upon income and cap rate, which is a factor of the income, is also a factor of the demographics in the area, the traffic counts, everything that we talked about a little bit earlier. So, what you're typically looking at, though, in the $2 million range is something along the lines of maybe a smaller AutoZone or a QSR fast food restaurant, about 2,000 to 3,000 square feet. AutoZones are probably 4,000 or 5,000. You could get a 10,000 square foot Dollar General in a tertiary market as well. Wouldn't necessarily recommend that, but so that is that ability as well. So it's a lot of that is also a factor of what kind of rents that you can achieve. For instance, I did retenant a old Wiener Schnitzel in Los Angeles for a client. And, the building itself is only about 450 square feet. but we got some very good rents over $200,000 a year. And realistically speaking, if we were to put it on the market, we're probably getting about 4 million due to the location right now. So, we're looking at over $1,000 a square foot, which, it all varies. So, yeah, so, it's harder to say. Actually, we're looking at 10,000 a foot for 4,400,000 square feet. Sorry.
No, just a decimal point there, not a big deal,
Yeah,
right?
just one decimal point,
Yeah,
rounding error.
yeah. No, I appreciate you kind of sharing that, because I think one of the things that as we talked a little before we started recording, was recognizing that, given the market, and for people that are looking to get in, maybe they've been curious or they've been kind of paying attention a little bit up to this point. You mentioned the down payment, kind of the what the investors' expectations were, how much he thought he could buy, as opposed to the reality of the changing interest rates, and also what the banks now are, and more of debt cover, or debt service cover ratio. I think, are you finding that the DSCR is kind of driving the limit of what someone can purchase based on what they have to invest, more than when interest rates were lower?
Absolutely. Right now, especially, because we're dealing with properties that, with the cap rates where they are, they're still compressed more than what the interest rate increases have been. So they have not increased as much. So it's also then affecting how much they can borrow. When you start looking at that, and then we're already talking about how, there's an article out that the back to work for office is going to cause roughly an $800 billion loss in value, because a lot of the value of a property is based upon the income, not just the square footage. If you have a vacant building, no one's going to pay you as much as if you have it fully occupied. So it's not just the square footage that people are looking at, but what we're looking at is also the income and the potential for income. So when we're running into these situations with the debt service coverage ratios, if you have a building that was 80% occupied when you purchased it and is now 60% occupied, and your loan comes due, because what investors don't realize is almost all commercial loans have a due in 10 clause. So they're typically amortized over 25 years with a balloon payment at the end of 10 years. Now, they do have fully amortizing loans, but those are typically on a 15-year amortization, which most investors don't get because it kills the cash flow. And then, and it's different for multifamily, but we're talking about straight commercial here. So when you look at that, and I'm looking at a 80% occupancy down to a 60%, and also in a declining market, obviously, again, I'm a big believer in economics and the basic laws of economics. So if you have now an increase in demand or supply because there's so much more available, but demand really is actually even going down, your rental rates are going to go down. So even though it's only about a what,
At least a 25% 80 drop in your occupancy,
to a 60% occupancy, a drop is about 25%, or not about, it is exactly 25% drop in your income. But then in addition to that, your expenses don't change for the operating the building. So it's really equates to about a 35% in your net operating income, which then allows, if you have to refinance now and you just bought the property 7 years ago when it was fully occupied, you likely will not be able to refinance for the amount that's due. And that's the issue that we're running into right now is, that debt service coverage ratio. And that's all about that. It's because the property is higher vacancy, less income, less opportunity for rent growth right now. And that's the issue that we're running into with the lenders and getting loans in place. So in that case, you're probably looking at about a 50%, if not higher, down payment.
Right. No, and having to come up with cash to refi.
Yes.
Or I mean, have you seen any of this play out? I mean, I understand the scenario, and I know there have been some larger syndications that at least with multifamily I've heard about, that have had some issues. But I would think that as the calendar continues to move forward, more and more of these that had a very favorable interest rate based on the terms of their loan, are going to come to maturity to where they're going to have to refinance or sell. And this valuation, just like you described, is going to become, not just a theory, but a reality.
Mhm.
And, people are going to be faced with this. Have you seen it play out recently, or is it more of like what everybody's expecting to come?
No, I mean, we're definitely seeing it right now,
Okay.
and have been seeing it for the last 6, 7 months, where people are looking to refi. I mean, there are notes that are coming due that very large property owners purchase, but they can't refinance it at this time. I mean, there's one of the largest landowners in Los Angeles just made news today. They're already in default because the loan came due. They're trying to do a workout, and they just requested a big workout, and we're talking 100 million plus loans. Um, the so we're seeing that happen already, but typically more on the larger scale, and lenders are a little bit more open to do workouts at that point. And so a lot of those investors are developer investors. What they're doing is, a developer typically gets a shorter term loan. So what they're not planning on staying that long, or if they're doing an acquisition rehab, you're doing a different type of loan that has to be refinanced out, and that is where they're getting caught a lot of as well, and they're having to restructure. Lenders are open to some restructuring, but it has to make sense for them as well. Ultimately, it doesn't do anybody good for the banks having to take back and foreclose on all the properties, because that way, in that scenario, almost everybody will lose.
Have you seen any of the workout terms, or do you have any kind of sense of what workout terms might look like?
Not really. I wish I had. I've been knock on wood here. My clients have not had that experience at this point. A lot of my clients, I tend to be and for myself with my investment portfolio, I tend to be very conservative. So I don't do high leverage. I am always looking at exit strategies. I always tell people I buy for cash flow. So even in a down market, I'm not worried. I'm going to cash flow. I'm going to be happy. I'm going to be fine. I'll wait for the market to come back up until I sell. Am I going to sell? I always tell everybody I'm not a seller in the market, but if somebody comes in and offers me a right price, yeah, I'll look at it and I'll sell it. In fact, I mean, the last property I had was that I sold was one in Texas that was a 72 unit apartment building. And, we had an unsolicited off market offer that came in. When we looked at the numbers, our plan was we were actually going to raise part of the building and redevelop it because it was a large lot. And when I looked at what they were offering, most of our profits were already built into it. So I was like, done. Took the
Yeah.
offer and ran.
Take the risk off the table. Don't have to get into the construction,
Absolutely.
all that stuff. Yeah. Good for
Yeah.
you.
So,
Good for you.
it's and I think that's how most people should look at their investments. A lot of them get a little too attached to it, where it becomes more of a, I love this investment that, and ultimately you should always, as an investor, be analyzing what your returns are, what your properties are doing, or your investments are doing at any given point, and can you do something better? Especially with the current market conditions and changes. Putting your head in the sand and not really addressing what's happening in the near future and mid future is one of the biggest issues I see with a lot of the mom and pop investors. They just don't, it's like, oh, it'll come back, but not really having a plan of action in case it doesn't.
Yeah. And putting your head in the sand is not going to work. If you do decide to do something, you've got to have a pretty good sense of what the options are. So
Mhm.
um, I get it. Let me ask you this. So we've talked a little bit about how the market's frothy. We've talked about how, some of the conditions and specifically with the lending environment and what's affecting borrowers and investors. For somebody that's looking to get started in investing here in 2023, what's the most critical thing that you would encourage somebody to look or to start, or what are the critical pieces of real estate investing, commercial real estate investing, that you see that somebody has to have a firm grasp of in order to move with some sort of a sense of certainty or to be up to speed to actually be successful in commercial real estate?
Well, great question. I think it depends on the asset class and what you're looking at. If you're doing commercial investments in multifamily, one of the reasons multifamily is so popular is almost everybody has rented an apartment one time in their life. They understand how that works, how the lease works, how the tenancy works. Commercial real estate is like true straight commercial retail office. It can be a lot more complicated. Instead of dealing with a lease that's 5-8 pages long, you're dealing with leases that are anywhere from 25 to 150 pages long. And that scares a lot of investors coming in like, well, I don't know how to do this. So it's really a matter of making sure they have the right team around them, because, if you're investing in property, even some very astute investors I know, and that are attorneys, they still hire their specialized attorneys to work with them on their acquisitions. It's finding the team behind you to be able to make sure that you have everything going in all buttoned up, so to speak. And that starts with the agent, the broker, making sure that they understand exactly what you're looking to accomplish and what you're looking to do. Then it goes into your title or a title and like your third party vendors to mitigate the risk ahead of time, going through the title survey, environmental reports, doing your due diligence ahead of time, but then also having your team for any legal issues that are in there as well. Like, who am I going to go to? You're not going to go to a transactional attorney if there's an eviction that needs to be done. So make sure that it's all in place and understand that you're not going to necessarily be there. But more importantly, I think investors really need to understand the commercial leases, what they can do and what they're allowed to do. Commercial leases, there's a lot less protections for the tenants than on a residential lease. And as such, there and a lot of commercial leases, the tenants are reimbursing the landlord for a lot of these costs that they may have to incur. But some landlords don't understand that. They never recharge it back, or they do the work, they won't hire the attorney or do something because they don't want to incur the cost, even though they would technically get reimbursed.
No, I like the answer there. Have a team that knows what they're doing, because
Yeah.
there's a lot of moving parts. And I think real estate to me is one of the most tried and true ways to accumulate wealth, but the risk is there, and without having a
Absolutely.
team.
More millionaires were created with real estate than any other form of investment.
Yeah. And but again, to the point there, having a team of experts
Yeah.
on your team
Mhm.
to help guide you through the kind of the uncertainties or the unknowns is just priceless. You got to make sure you got that. If somebody was looking to get into commercial real estate as perhaps a real estate professional, whether it be a real estate broker, a lender, or property manager, or something like that, what are some of the things you would encourage them to do in order to be successful in commercial real estate?
Well, again, firm believer in organization. So I'm always like, even agents, our new agents that come on board, I tell them, let's work on our business plan. Let's see what we're going to do, and really find, the way I look at it as well, especially when it comes to sales here, we're not high pressure sales. I'm not a salesman that's going to try and force a deal through or whatever, but rather I'm of the firm belief, find what you're passionate about, which asset class, what you're doing, and that passion will be conveyed to your clients, and that will then in turn have them come on board, as opposed to just selling. If you're going out there selling and it's like, I don't believe in it and whatever. I mean, one of the first things that was told to me when I first got into my career in real estate was, how can you recommend to somebody to invest in this property if you're not investing in any properties? And that really sunk in. It's like, okay. And frankly, I don't do stocks. My stocks are some retirement accounts and stocks, but they're all like more mutual fund stuff, because you know what, I think it's gambling. I think it's too risky. It's and whatnot. But I understand real estate, and I understand it, I think, very well. So all my investments are in real estate. And that's how I look at it. When you're getting into the business, have that business plan. If you want to be an agent, What do you want to do? How are you going to go about it? And understand that, but also look for companies that will be able to give a mentorship style versus to me, that I think works a lot better than a company that is like, do this, do this, do this without explaining it. So find a company that fits your personality, that's going to help you learn. But at the same time, don't be afraid to ask questions wherever. I mean, my business partner and I, we actually do training, or he does, not so much me. I do training in our office. He actually trains agents around the country. And, and I always throw it out there as well. When I'm talking to an agent, if I'm recruiting them, and speaking to them, I'm saying, well, here's what we're doing. Let's meet and talk. No expectations. Worst case scenario, you come away with a couple ideas that we're doing that you might be able to incorporate into your business. And then we likewise here. Also, I think the biggest thing, network, not just with clients and people who can refer business, but other agents. I have a pretty good network of agents around the country that if I needed to pick up and find out what was going on in Miami, I could pick up a phone call. They're going to do it, and they'll actually do some work for me and do some research and send it back to me probably within a day or two. If I have agents that are sending me off market deals for my clients around the country, and that's just from network and being in it for so long. I also, some seminars we go to, I recommend that. Especially when you're starting off, one for networking, but also learning what the top agents are doing in their marketplace. And if you emulate success, it's going to potentially increase your chance of success.
No, I love it. I love the if you're selling real estate, it's good to invest in real estate. It reminds me of Zig Ziglar. If you're selling Fords and you're driving Chevys, you got it all wrong. You gotta know what you're doing there. So that's good. Hey, George, if we could, I'd like to shift gears here for a second.
Sure.
By day, I'm an insurance broker. And as such, I work with my clients to assess risk and determine what to do with the risk. And there are 3 strategies that we typically consider. We first look to see if there's a way we can avoid the risk. If that's not an option, we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, we look to see if there's a way we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guest if they can look at their own situation. It could be your clients, investors, tenants, market, the political air, the Fed, however, and identify what you consider to be the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, George Pino, what is the biggest risk?
Biggest risk. I'm going to answer that as the biggest risk I see for investing in real estate when you're getting started, because that's kind of what we're talking about as well. And the biggest risk there, I think, is we see this happen a lot. And you'd mentioned like jumping on the bandwagon. I am constantly getting calls, and our office is getting calls over the last month and a half about adaptive reuse for office space, and yet people have no clue what that is or how to go about it. But they hear about it and they read it, and I want to do this, not understanding the whole business of it, and that right now at this point it's just too cost prohibitive for the most part. It may not be, especially if the government's come in and give some incentives. So, I think jumping on the bandwagon, but I think that correlates into the ultimate answer, which is not doing your homework or due diligence ahead of time. Just here's my investment money. This is what I heard was going to happen. This is what I'm going to do. I think the program that you're talking about, as far as an insurance company, identifying the risk, mitigating the risk, transferring the risk. Absolutely correct in any type of aspect, and investors should be looking at that as well. Identifying what the risks are, then mitigating and or transferring it. Part of that is also not understanding what's going on in the future or reading that. And we don't have crystal balls. I don't have a crystal ball. No one has a crystal ball that I'm aware of. Was at the Magic Castle a few weeks ago. They had a crystal ball there, but I don't trust it. But when you're looking at the future, though, you can still kind of see what's happening. You know what laws are going to come into place. You know if it's going to be a headache. If right now there's insurance industry, at least in Southern California, we're having some issues. There's a lot of carriers that are pulling out of California, and that's going to cause an increase in your insurance rates. Now, if you're in a single tenant net lease or a net lease property, sure, you're looking at, well, the tenants are going to pay for that, but you have to think a little bit further. If your triple net expenses are too high, then they're going to offset it by trying to lower the rent. So it can't just be a complete pass-through. You have to think about, well, what's going to work for everybody. And also, the last thing you want is to pass through expenses that cause your tenant to go out of business. So you have to really think about how to go about that and how to plan for that action. A lot of people don't really think about that. I mean, speaking of insurance, I just got a insurance person. I had a company that just denied insurance on property because the neighboring property had too many homeless people based upon aerial photos. So the insurance companies are getting very picky and pushing, and that's been an issue. But you have to understand that going in, if you're investing, that this is going to just be part of my investment strategy. Here are my expenses. They may be this today, but in reality, after I close escrow, it's going to be here. And a lot of people don't really look at that and have a plan for that action. They're just kind of looking at that snapshot today. And I think that's the biggest risk that they have if they're just not taking the whole picture in.
No, very, very well said. Take in the whole picture and make sure you have a good idea of what you're getting into. I like it.
Yeah.
Hey, George, where can the listeners go if they'd like to learn more or connect with you?
Absolutely. Best way is my website, cbicommercial.com. That's Charlie Bravo India, and then the word commercial.com. Also, Instagram is Pino CRE. That's also I do quite a posting, but more LinkedIn these days. And just always reach out. We're always here to help out. I don't mind any questions, whether they are first-time investors or very astute investors.
Awesome. George Pino, I cannot say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Well, thank you, Darren. I enjoyed it very much so. Thank you so much for having us.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.